Good evening. If you've been watching the markets, reading the financial headlines, or simply paying attention to the undercurrents of global trade, you may have noticed something unusual happening in the mining sector. Over the past few weeks, a term that rarely appears outside of contract law and insurance disputes has surfaced repeatedly in press releases and investor calls. Force majeure. It's a legal declaration. A clause invoked when circumstances beyond a company's control make it impossible to fulfill obligations. And right now, it's being declared by mining operations around the world, not because of weather or natural disaster, but because the systems that extract, refine, and deliver industrial metals are under strain in ways we haven't seen in decades. This isn't a story about one mine or one metal. This is a structural issue, a signal that the supply chains we've taken for granted are beginning to fracture. And within that broader context, silver has emerged as the focal point, not because it's the only metal affected, but because it sits at the intersection of industrial necessity and monetary relevance. If you hold silver, or if you've been considering it, this moment deserves your attention. Not because of panic, not because of hype, but because something fundamental has shifted, and understanding that shift is what separates thoughtful investors from those who simply react. Let's start with what force majeure actually means in this context. When a mining company declares force majeure, they are formally notifying their buyers that they cannot deliver the contracted amount of metal. This can happen for many reasons: flooding, equipment failure, labor strikes, regulatory shutdowns. But what we're seeing now is different. Companies are citing energy shortages, permitting delays, logistical breakdowns, and in some cases, the simple inability to source the inputs needed to keep operations running. These are not isolated events. They are symptoms of a system under stress. And silver, more than almost any other metal, is vulnerable to these disruptions. Why? Because silver isn't primarily mined for its own sake. Roughly 70% of global silver production comes as a byproduct of mining other metals, mainly copper, lead, and zinc. When those primary operations slow down or shut down, silver production falls with them. It doesn't matter if silver prices rise or demand increases. If the copper mine stops, the silver stops too. This is not a market that responds quickly to price signals the way equity markets or even gold markets do. Now, let's talk about demand. Silver is unique because it serves two masters. On one hand, it's an industrial metal, used in electronics, solar panels, medical equipment, and a growing list of green technologies. On the other hand, it's a monetary metal, a store of value with thousands of years of history, recognized by central banks, investors, and everyday savers as real money. This dual nature creates a tug-of-war that most commodities never face. When industrial demand rises, supply tightens. When monetary demand rises simultaneously, the strain compounds. And right now, both are rising. Let's consider the industrial side first. The global push toward renewable energy, electric vehicles, and digital infrastructure has placed silver at the center of the so-called green transition. Solar panels alone consume enormous quantities of silver for their conductive properties. Each panel requires a certain amount of silver paste to function efficiently, and as solar installations accelerate worldwide, that demand is structural, not cyclical. It doesn't go away when markets dip. It grows. Electric vehicles, 5G networks, semiconductors. These are not speculative projects. They are the foundation of the modern economy. And all of them rely on silver in ways that substitutes cannot easily replicate. There are alternatives, yes. But alternatives often come with trade-offs in performance, cost, or scalability. The market has chosen silver because it works, because it conducts electricity and heat better than almost anything else, and because for many applications it remains the most cost-effective solution even at higher prices. On the monetary side, the picture is equally compelling, though for different reasons. We are living through a period of unprecedented currency creation. Since 2008, and especially since 2020, central banks have expanded their balance sheets at rates that would have been unthinkable a generation ago. The money supply has grown faster than the underlying economy, faster than productivity, faster than the tangible goods and services that give money its value. This is not a controversial statement. It's observable in the data. When the supply of money increases faster than the supply of real things, prices adjust. We call that inflation. And while headline inflation numbers may rise and fall depending on how they're measured and what's included, the underlying reality remains. The purchasing power of fiat currency is eroding. This isn't happening overnight, and it isn't happening in a straight line, but it is happening. And thoughtful people, investors, institutions, and even some governments are responding by moving a portion of their wealth into assets that cannot be printed. Gold gets most of the attention in this conversation, and rightly so. It's the anchor, the monetary metal with the deepest liquidity and the longest track record. But silver has always been gold's companion, the people's money, the metal that ordinary savers could accumulate in meaningful quantities. And when the ratio between gold and silver prices stretches too far, as it has in recent years, silver becomes statistically attractive on a historical basis, not as a guarantee, but as a probability worth considering. So we have industrial demand rising, monetary demand rising, and now supply under pressure. That's the setup. But let's be clear about what this means and what it doesn't mean. This is not a prediction that silver will double or triple in the next 6 months. Markets don't work that way, and anyone telling you they know what the price will be next week, next month, or next year is either lying or deluded. What we can say is that the conditions for a supply-demand imbalance are more pronounced now than they have been in a long time. History offers some guidance here, though history never repeats exactly. In the 1970s, inflation ran higher than interest rates for much of the decade. Bonds lost value in real terms, equities struggled, and commodities, particularly gold and silver, outperformed nearly everything else. That period ended when central banks raised rates aggressively, when political leadership changed, and when the inflationary psychology broke. It took years, it took pain, but it happened. We are not in the 1970s. The debt levels are higher, the financial system is more complex. The geopolitical landscape is different. But the underlying dynamics, currency debasement, rising commodity demand, supply constraints, these are not new. They are recurring themes in economic history, and they tend to resolve in predictable ways over time. Not in days or weeks, but across years and cycles. Let's talk about what this means if you already hold silver. First, you need to understand why you hold it. If you bought silver as a speculative trade, hoping for a quick flip, you may be disappointed. Silver is volatile. It can rise sharply and fall just as fast. It doesn't pay dividends. It doesn't generate cash flow. Its value lies in what it is, not in what it does. If you're holding silver as a speculation, you need to be honest with yourself about your risk tolerance and your time horizon. But if you hold silver as part of a diversified strategy, as a hedge against currency risk, as a store of value outside the banking system, then this environment should not change your thesis. In fact, it may reinforce it. The forces that made silver attractive as a hedge, monetary expansion, geopolitical uncertainty, supply constraints, those forces have not diminished. If anything, they have intensified. That doesn't mean the price will rise in a straight line. It means the reasons for holding it remain valid. Patience is not a popular virtue in financial markets. We live in an era of instant information, instant gratification, and constant noise. But real wealth, the kind that lasts across generations, is built slowly. It's built through discipline, through understanding cycles, and through refusing to panic when everyone else does. If you hold silver and the price drops tomorrow, that doesn't invalidate the fundamentals. It tests your conviction. And that's the point. Markets are designed to shake out weak hands. The question is whether you're holding for the right reasons. Now, what if you don't hold silver? What if you're watching this situation unfold and wondering whether you should get involved? The answer depends entirely on your financial situation, your goals, and your understanding of the asset. Silver is not for everyone. It's not a get-rich-quick scheme. It's not a magic bullet. It's a tool, and like any tool, it works best when used correctly. If you have high-interest debt, if you don't have an emergency fund, if you're living paycheck to paycheck, silver is not your priority. Your priority is stability. Pay down debt. Build savings. Get your financial foundation in order. Silver is for people who have already done that work, who have margin in their lives, and who are thinking about the next decade, not the next month. For those who are ready, the question becomes one of allocation and timing. Allocation first. No serious financial advisor, no one with credibility, will tell you to put everything into one asset. Diversification exists for a reason. It spreads risk. It smooths returns. It protects you from being catastrophically wrong. A reasonable allocation to physical metals, whether gold, silver, or both, might be 5%, 10%, perhaps more if you're particularly concerned about monetary risk. But that's a personal decision, not a prescription. Timing is trickier. The truth is, no one knows the perfect entry point. You can wait for a pullback, and the price might run higher. You can buy today, and it might drop tomorrow. This is the nature of markets. What disciplined investors do is average in over time. They buy a little now, a little later, building a position gradually, without exposing themselves to the risk of buying everything at the top. This approach won't give you bragging rights, but it will give you peace of mind, and in the long run, that matters more. Let's address some of the misconceptions that circulate in online forums, on social media, and even in some corners of financial media. There's a narrative that silver is about to explode, that it's being manipulated, that a short squeeze is imminent, that anyone not buying right now will miss the opportunity of a lifetime. Some of this is true in pieces. Yes, silver markets have experienced manipulation in the past. Yes, there are structural imbalances. But the idea that a sudden, dramatic price spike is guaranteed, or that it will happen on a specific timeline, is fantasy. Markets are messy. They are influenced by thousands of variables, many of which cannot be predicted or controlled. When you hear someone promising that silver will hit a specific price by a specific date, you should be skeptical. Not because it's impossible, but because certainty in financial markets is a red flag. The people who make the most money in markets are not the ones making bold predictions. They're the ones managing risk, staying patient, and positioning themselves to benefit from probabilities, not certainties. There's also a psychological trap worth mentioning. When prices rise, people feel smart. They feel validated. They want to tell others. They want to buy more. This is euphoria, and euphoria is dangerous. Conversely, when prices fall, people feel foolish. They doubt themselves. They consider selling. This is despair, and despair is equally dangerous. The investors who succeed are the ones who can recognize these emotions and act contrary to them. Buy when others are fearful. Hold when others are panicking. Sell, if you must, when others are euphoric. This is easier said than done, but it's the discipline that separates long-term wealth from short-term luck. Now let's consider what you should absolutely not do. Do not borrow money to buy silver. Do not use leverage. Do not bet money you need for rent, for food, for your children's education. Do not follow someone on the internet just because they sound confident or have a large following. Do not assume that because something makes sense logically, it will happen quickly. Markets can remain irrational longer than you can remain solvent, as the saying goes. Protect yourself first. Do not chase headlines. Every week, there will be a new crisis, a new revelation, a new reason why silver is about to skyrocket. Some of these will be real. Some will be exaggerated. Some will be completely fabricated. Your job is not to react to every piece of news. Your job is to understand the bigger picture and stay focused on that. And please, do not view silver as a replacement for a diversified financial plan. It is one piece, not the whole puzzle. You still need income. You still need liquidity. You still need assets that can grow, that can be borrowed against, that can be passed to your heirs. Silver is a hedge, a form of insurance, a store of value. It is not a complete wealth strategy on its own. Let's talk briefly about what happens next. The truth is, we don't know. We can observe the trends. We can read the data. We can listen to the signals from mining companies, from industrial buyers, from central banks. But markets are complex, adaptive systems. They surprise us. They humble us. What we can do is prepare for a range of outcomes, not just the one we think is most likely. If supply constraints persist and demand continues to rise, prices will adjust upward. That's basic economics. But that adjustment may take months or years. It may happen in bursts, interrupted by sharp corrections. It may be accompanied by volatility that shakes out everyone who isn't prepared emotionally. And there's always the possibility, however unlikely, that new supply comes online, that substitutes are found, that demand falls. We have to hold these possibilities in mind without letting them paralyze us. And one thing seems increasingly clear. The era of cheap, abundant commodities may be ending. Not overnight, not in a straight line, but as a long-term trend. The easy oil has been extracted. The easy copper has been mined. The easy silver is gone. What remains requires more energy, more capital, more time and more risk. And that means higher costs, which eventually translate to higher prices, absent a major technological breakthrough or a collapse in demand. This is not a crisis. This is a cycle. Commodities go through long periods of underinvestment, followed by shortages, followed by price spikes, followed by overinvestment, followed by gluts. We've seen this pattern in oil, in copper, in iron ore, in agriculture. Silver is no different, except that it has that monetary component that adds another layer of complexity. When people lose faith in currency, they don't turn to copper. They turn to gold and silver. If you're someone who believes that central banks will eventually restrain money creation, that fiscal discipline will return, that inflation will be conquered quickly and permanently, then you may not find silver compelling. That's a valid view. It's a view held by serious people with impressive credentials, but it requires a level of faith in institutions, in political will, and in historical precedent that many thoughtful observers simply don't share anymore. The alternative view, the one that underpins much of the bullish case for silver, is that we are too far down a path of debt and monetary expansion to reverse course without severe economic pain. That the political incentives favor continued stimulus, continued spending, continued easing whenever the economy falters. That the pain of austerity is politically unacceptable, and therefore the easier path, the path of least resistance, is to continue inflating. If that view is correct, then hard assets, tangible things that cannot be created by decree, become more valuable over time. Which view is right, we'll find out. But you don't have to bet everything on one outcome. You can hedge, you can hold some silver, some gold, some real estate, some equities, some cash. You can be prepared for multiple scenarios. That's not indecision, that's wisdom. Let me speak directly to those who are feeling anxious. Financial anxiety is real. It's based on the recognition that the world is uncertain, that the future is unknowable, and that mistakes can be costly. But anxiety is only useful if it drives action. If it paralyzes you, if it keeps you from making decisions, then it's working against you. The antidote to anxiety is not certainty, it's preparation, it's education. It's the confidence that comes from understanding what you own and why you own it. If you hold silver, take time to remind yourself why. Write it down if you need to. When the price swings wildly, and it will, you'll have something to anchor you. If you're considering silver, take time to learn. Read widely. Listen to different perspectives. Don't rely on any single source, including this one. Build your own understanding so that when you make a decision, it's yours, not someone else's. And remember, the goal is not to be right about every trade, every timing decision, every allocation. The goal is to protect and grow your wealth over the long term, to sleep well at night, to avoid catastrophic mistakes, and to be positioned so that when opportunities arise, you can take advantage of them without desperation. That's the mindset of a successful investor. Not flash, not bravado, not certainty, just discipline, patience, and preparation. We are living through a period of transition. The financial system that has governed the world for the past several decades is under strain. That doesn't mean it will collapse tomorrow. It doesn't mean you should panic. But it does mean you should pay attention. The signals are there, the data is there, the historical patterns are there. Whether you choose to act on them is up to you. Silver, in this context, is one option among many. It's not the only option, it's not the best option for everyone. But for those who understand its role, who appreciate its dual nature, who recognize the forces that drive its value, it can be a meaningful part of a resilient financial strategy. Not because it will make you rich, but because it can protect you when other things fail. In closing, let me say this. The headlines will continue. The noise will continue. The predictions, the hype, the fear, all of it will continue. Your job is not to absorb all of that. Your job is to filter it, to extract what's useful, and to ignore the rest. Stay informed, but don't be overwhelmed. Stay engaged, but don't be impulsive. Stay disciplined, even when it feels boring. The investors who thrive over decades are not the ones who make the most dramatic moves. They're the ones who make the fewest mistakes. They're the ones who understand that wealth is built slowly, protected carefully, and passed on thoughtfully. They're the ones who recognize that markets go through cycles, that fear and greed drive short-term behavior, and that the rational, patient participant has an edge over the reactive, emotional one. If you take nothing else from this, take this. Understand what you own, know why you own it, and don't let the market's mood dictate your decisions. Whether you hold silver or not, whether you buy more or wait, make that choice from a place of understanding, not emotion. And whatever you do, keep learning. The world is changing, the economy is changing, but the principles of sound investing, diversification, patience, discipline, those don't change. They've worked for generations, and they'll work for you. Thank you for your time and your attention. Stay thoughtful out there.